Entrepreneurial ventures are central to driving economic growth, innovation, and job creation, but early-stage businesses often face challenges like limited financial resources, lack of expertise, and weak networks, which make it hard for them to grow. Traditional funding methods, like bank loans, usually aren't a good fit for startups because of their high risk and limited operating history. This funding gap is where venture capital becomes important. It's a specialized form of financing focused on supporting startups and high-growth potential businesses. Venture capital firms don't just provide money, they also offer strategic guidance, governance, and hands-on support to help these companies succeed. This approach involves a structured process where venture capitalists carefully select and invest in early or growth stage companies with the goal of achieving significant returns. Throughout this presentation, we'll explore how this model works, its benefits and drawbacks, real-world examples, and why it plays a crucial role in today's business environment. The image here shows how venture capital acts like a driving force, represented by an arrow, helping the various parts of a business, symbolized by gears, work together toward growth and value creation. Venture capital investments involve taking equity ownership in businesses, meaning investors share both the risks and rewards. This model focuses on funding innovative and scalable companies, accepting high failure rates with the hope of achieving some major successes. Investors are actively involved in management and strategy and have a clear goal of exiting investments through acquisitions or IPOs. The investment process covers different stages, from seed and early-stage funding through growth capital to exit. For startups and growing companies, venture capital offers important benefits. It provides access to capital when other funding sources are limited, which is crucial for tech startups with few tangible assets. VC firms also bring strategic expertise and mentorship, helping founders refine their business models, scale operations, and avoid common mistakes. They offer valuable networks, connecting startups with customers, partners, suppliers, and future investors, which accelerates growth. VC investors typically take board seats and introduce formal governance structures, improving decision-making and accountability. Additionally, securing venture capital boosts a company's credibility, making it easier to attract employees, customers, and further investment. The venture capital process usually starts with deal sourcing, where firms identify potential investments through various channels such as networking, incubators, accelerators, university connections, and referrals, though only a small fraction of these opportunities advance to actual investment. The venture capital process starts with an initial screening to evaluate factors like market size, product innovation, competitive advantage, and the strength of the management team. If a company passes this stage, it moves into detailed due diligence, which includes financial analysis, legal checks, and a thorough technology review. Once a company looks promising, the investment terms are arranged based on its valuation and growth prospects. These terms often include preferred shares, liquidation preferences, and protections against dilution to help manage risk. After investing, venture capitalists take an active role in supporting the business, such as joining the board, helping to recruit senior staff, refining business strategies, and keeping close track of performance. The goal is to eventually exit the investment within 5 to 10 years, commonly through an initial public offering, a trade sale to another company, or a secondary buyout, which generates returns for both investors and founders. To put this into perspective, Google's early funding from Sequoia Capital and Kleiner Perkins in 1999 allowed it to scale infrastructure and attract talent, leading to a highly successful IPO. Uber used multiple rounds of VC funding to support global expansion, technology development, and brand building despite early losses. Spotify leveraged venture capital to compete in the music industry and expand internationally, with strategic guidance helping to refine its subscription model. In the UK, venture capital has notably supported fintech startups like Revolut and Monzo, enabling rapid scaling in competitive banking and payments markets. These examples show how venture capital not only provides money but also valuable support to help companies grow and succeed. Venture capital plays a key role in driving innovation by funding new technologies and business models that might not get support otherwise. It helps companies grow quickly and take a larger share of the market, which is a big advantage. Beyond just money, venture capitalists offer strategic advice, governance, and valuable industry connections. This shared financial risk also reduces the burden on entrepreneurs personally. Venture-backed companies create jobs and contribute significantly to the economy. However, there are downsides too. Entrepreneurs often have to give up some control and decision-making power, which can be tough. These companies also face strong pressure to grow rapidly, sometimes sacrificing long-term sustainability. Access to venture capital is limited to a small number of startups, so many don't get the chance. The high failure rate reflects the risk involved, and ultimately, success depends on achieving favorable exit conditions, which can be affected by market changes. Despite these challenges, the venture capital model is vital for supporting innovative firms that can transform industries. When paired with capable management and real market opportunities, it creates strong value for investors, entrepreneurs, and the broader economy.